Welcome to Notch by Notch with Hotch, where we teach retail investors the secrets and hidden truths that hide in the finance industry. Our second guest is Peruvian Bull. Peruvian Bull is a Peruvian American scholar, researcher, and educator hailing from the Pacific Northwest. Born and raised in Seattle, he attended a local university where he graduated magna cum laude with degrees in finance, economics, and entrepreneurship. He has studied also in South America and plans to complete a master's degree at the London School of Economics. He currently works at a private equity fintech firm as an analyst and advisor for financial services.
Printing money out of thin air, banks create a dream. Loans based on credit and infinite liquidity, nothing's as it seems. Assets backed in the vaults, no, that's just a guarantee. Fractional reserve lending is quite risky. Join the tally stick and see.
Thanks for joining today. For today's guest, I am bringing in Peruvian Bull. Peruvian, welcome to the stream.
Hey, how's it going?
Good. Yourself?
I'm doing well. Excited to chat. I know there's a lot of stuff going on with the markets, with economics, with GameStop. There's a lot to talk about, so I'm excited to chat.
Yes, there is. And we might as well start out hot and right into it. And I'm going to start with a question that I did not send you. And it's, what is your view on the crypto landscape in the upcoming single year, just in this next year alone?
The crypto landscape. Well, I'm pretty bullish. I wrote a piece back in November, late November, early December, that I titled "The Golden Bull." And in this piece, I was basically describing, are we setting up for a golden bull crypto market, which essentially means that it's like a perfect storm where all the contingent factors that we need to see for a proper bull market are able to come online at the same time. And essentially what I was saying is that, in previous cycles, we've had one of the three or two of the three factors, but not all three. And the three factors are retail buying and retail adoption, regulatory clarity, and also macro tailwinds. And so when you think about like the 2017 cycle, we saw massive moves in Bitcoin, Ethereum, in a bunch of altcoins like Litecoin, but that was mainly driven by retail buying, and retail was only able to get it so high before it was before the price collapsed. And then in 2020 and 2021, we saw another massive crypto bull market. That one was bullish because not only do we have retail adoption and actually increased retail adoption from the 2017 cycle, but we had huge macro tailwinds. So the Fed was easing, they were lowering rates all throughout 2020 and 2021. We had massive amounts of liquidity being pumped into the system, and that caused a move out the risk curve for basically all risk assets, but none more so than crypto. And so you saw, every single meme coin start to pump. We saw NFTs start to move. You saw it, like gambling kind of revive itself. All these things that were bullish for the crypto sector were coming into play, but the problem was we didn't have regulatory clarity, right? We had Gary Gensler, the head of the SEC. He was pursuing ETH as a security. He said that it failed the Howey test. He then started going after, some of the more notable ones that were frauds, obviously, like Celsius or FTX. But then he also started going after, everyday projects. And he didn't provide enough clarity, and not even to mention like Tornado Cash, or Samurai Wallet. Like there was a concerted effort at the highest levels of government to crack down on the cryptocurrency industry. And now with Gary Gensler leaving office and a new SEC chair in the process of being appointed, there's room for us to have a brand new regulatory apparatus that will be much more friendly to the crypto space. And I think that Trump has essentially signaled that with some of his messaging as well as his own actions, right? We were talking earlier about the crypto coins that Trump and Melania have launched. And while I'm not a fan of him launching those coins, because in my opinion, he's just taking advantage of his fan base, but I am a fan of him being more pro crypto and more pro regulatory clarity. And so
Well,
it's kind of a
as you
mixed
just
bag.
right, and as you just brought up, the Tornado Cash founder Alex just got let out this morning.
Oh, really?
Yes, so not only is Ross free, now Alex is free. So with you mentioning that, regulatory clarity is starting to occur, it doesn't I don't know that I have also saw that clarity laid out, but we are seeing the mistakes that were made being corrected slightly, because freeing Ross and freeing Alex is kind of a huge precedent, but that doesn't make using Tornado Cash, in the clear, or does it, in your opinion?
Well, no, I'm not saying that necessarily brings them in the clear, because especially Samurai Wallet, the developers were bragging about illicit criminals using their tumbling service to evade authorities. I'm not saying that, but what I'm saying is that overall the industry has suffered from a lack of regulatory clarity for years, and no one was sure about what was a scam, what was not a scam, could things be prosecuted, could the SEC crack down in these ways? How do you actually say SEC compliant if you're trying to create a project that is at least has bona fide intentions? And so getting that clarity is necessary for, especially for more capital to flow in, right? If you're an investor, I mean, I would invest in an industry where you have no idea what the regulatory authorities are going to do. Like that's just too risky.
That makes sense. So with what would you need to see in order to say, all right, these guys have clear regulatory authority now? As in, what would be the requirement for dApps and other, programmers to start switching to only, focusing more on a crypto based environment?
Well, I would say for one, there needs to be regulatory clarity on what is, what's a token, what's a good faith like agreement between the token creator and the community at large, and what are acceptable limits for insider ownership, for vesting periods, for VCs. Like the Hawktua coin, where 80% of the supply is held by top 10 holders, or same thing with even like the Trump coin, where it was the same thing, 80% held by VC funds, then it gets unlocked over Trump's 4-year term. That is unacceptable. That's completely unacceptable. And so if you're doing a security, it should be max 20% or 30% insider ownership, and the rest should just be free float. And there should also be rules around how the funds are managed, what the funds are used for, performance based milestones, performance based judgments. So if a project is promising to try and, let's say, create a decentralized VPN network that runs on a cryptocurrency like Mysterium, I don't know if you're familiar with that. That's one of the projects. If you don't even
Like,
try to if you don't even try to make a VPN network work, then you should be charged with fraud, and you should be going to jail. But if you try and it just doesn't work out, and you show in good faith, like your business idea, etc., you had a good attempt at it and it didn't work, then that's a business, right? You're buying essentially a tokenized security, and you understand the risk you're taking. But if you're just scamming people, No, you deserve to have all your money taken away, and you should be in jail.
Well, and you just brought up Haktua. Wasn't didn't she go live yesterday with FaZe Banks? I haven't had the opportunity. I was busy, but I'm pretty sure she's up to something now also. So it I am not a fan of what she did with like you said, she had 96% held between 10 wallets and then rugged everybody and then provided a lawyer for them to contact to sue the people that she had hired to run the coin for her. So
Mm,
it's all sorts of mixed up. We'll go with.
yeah, it's a complete mess.
Um, to sort of switch pace, I want to talk about gold a little bit. Over in London, the central banks, have been having issues with deliveries of the amount that has been purchased. So they have had a 4-day delay turn into up to 8 weeks. And what is your take on the current gold crunch, considering gold is already at its all-time high?
Yeah, well, I think that this is really interesting, right? We're seeing the beginnings of what appears to be the the foretold gold market breaking. And this is something that people have been blogging about since literally like the 90s gold bug forums. If you follow the writings of another or FOA, um, both of them were talking about the gold market completely breaking and the paper market essentially failing to deliver on the underlying physical. And I chatted with Stormy Waters about this on my podcast, but it's important to note that, in the West, we have the LBMA and we have the COMEX, and both of them are 97% cash settled um, exchanges. So they're futures exchanges that are basically just rolled forward for cash, and no one ever accepts delivery of the physical. And the reason why is multifold. If you accept delivery, you incur storage fees, transportation fees, security fees. It's no longer, if you use COMEX, they have a designation that's called like good for sale or something. And let me look it up. It's called good delivery status. And if you take personal delivery of it and it's no longer in their warehouse, you lose good delivery status and it's harder to sell. So for all these different reasons, it made sense for people to just take cash delivery. The problem is that allows the exchange to take, let's say 30,000 ounces of physical gold and naked short sell, quote unquote, like sell a bunch of naked futures contracts on top of that gold and use that to basically make money and also suppress the price of gold, because now all this institutional demand, all this personal demand is all going to institutions. All this money is going from institutions into the coffers of the exchanges, and none of that money is going to physical gold markets. It's not reflected in the physical gold, and so it's just being rerouted into paper derivatives. And the problem with this system is that it because it's so, I guess you could say, fragile, but also opaque. It allows the bullion market makers to just continue until they get to 200 to 1 or 300 to 1 leverage against the physical, which is what Stormy estimated the London gold market to be at, around 300 to 1 paper ounces for every physical ounce of real gold. And then if there's ever an actual run on the bank, right, like a few tons of gold redemptions, and the banks are dried and it's done. And then what happens is the physical gold market will shoot upwards vertically and the paper market will collapse. If you have claims, they're no longer worth anything. And the Bank of England has been selling for the last 4 weeks. They've been selling gold certificates into the market, which are essentially promises to redeem gold. And there's now an 8-week queue to redeem the gold certificates. And those gold certificates are trading at a discount to market prices, because what the market is essentially saying is, we don't believe that you actually have the gold that you say you do, Bank of England. You're a liar. And, we'll buy these and maybe we'll try to redeem them for physical gold. But we think that there's a certain point at which all the people who bought it are not going to be able to redeem. And at that point, they're holding a worthless piece of paper that they paid $2,000 for, or whatever the equivalent amount in British pounds. And so that's a problem because that's showing that the strain in the system and the rush to gold and inflation hedges is accelerating, and the paper market its collapse is soon approaching. And so we're gonna see how this plays out, but I think we're in the early stages of a gold snap up, and that could be indicative of just broader inflationary pressures in the system.
Okay. And so the people you had mentioned, I don't really follow. I'm not the biggest gold bug, but I
Mhm.
did learn a lot from Chris Powell. I don't know if you're familiar with him.
Chris Powell,
Uh,
no, I've never heard of him.
so he, I'm gonna say it wrong, so I don't want to talk on it too much, but he's one of the people that has been one of the loudest advocates against central banks and certificated gold. He had stated something along the lines of the average uh, central bank audit of their gold reserves loses, or not loses, but is 1 to 100 certificated per ounce.
Mhm.
I don't know, with the guesstimate that you had just mentioned at like 200%, he might be using a little different data or whatever, but he was on The Gist a few years ago. And that was actually when I had first learned that, wow, gold is traded exactly like the stock exchange, where,
Mhm.
everything's in a depository and you're really just trading guarantees that are electronically ledgered.
Mhm. That's
So,
exactly it. That's exactly it. No, like I remember when I did my very first dollar endgame, one of my first dollar endgame posts, I was talking about how the US under the Bretton Woods system had created all these dollars, right? And these dollars were circulating internationally for a global trade. And due to Triffitt's dilemma, they were forced to be exported, and the US printed 3 times as many paper dollars, as was justified under the reserve ratio, under the $35 an ounce. And French President Charles de Gaulle did the calculus in the early 1960s, and he's like, look, what the hell is going on? There's enough paper dollars in Europe alone for the entire US gold supply, not to mention Asia and Africa and the rest of the world. They've probably oversupplied the amount of paper dollars by 3 to 1. And so he called their bluff, and somebody very intelligently commented under that post. He's like, wait, so the US was naked shorting gold and with their dollars? And I'm like, wow, that's a really good way to think of it. Yeah, that's exactly what was happening, and that's what's happening right now in the futures markets on the COMEX and the LBMA. They've naked short gold every single day. And again, that works until people demand the underlying, until they demand the physical. And if everyone's demanding the physical, you very quickly run out of gold when you're only back 3%, real gold to stated paper certificates. So here's the other interesting thing, right, about the gold market is in the past, right? Again, it's had this issue of being normally cash settled. Normally, the futures are rolled forward, and this makes sense because if you think about it, again, if you're a hedge fund in the US, if you're an institutional investor, or if you're a private investor, do you really want to take delivery of hundreds or thousands of ounces of gold and then you have to figure out where to store it? That's extremely difficult to do. And so it made sense structurally why the West was basically just cash settled. And there's enough trust, latent trust in the financial system, that people just believed that the gold was really there. The difference comes in China, where the Shanghai Gold Exchange, for example, is a primarily physically settled exchange. So it's inverted, whereas the cash settled US markets and London markets are all 97% uh, settled in cash. The SGEI, which is their Shanghai Gold Exchange International, is settled 97% physical. And so what that means, and that's because of the investor base there is far different than the Western investor base. The Chinese are very, very skeptical about their own financial system because they've had multiple banking panics. They've had their deposits wiped out. They've been scammed by real estate development companies like Evergrande, where they have bought properties that are unbuilt, and then those properties never get built, and then they don't get their money back because the company goes bankrupt and goes under. So there's very high amounts of skepticism, and every single year there's a huge amount of capital that's fleeing China. We're talking, 120 billion a year, a huge amount of money, and that's with capital controls. And so one way that they have a release valve is through the Shanghai Gold Exchange. Is domestic Chinese investors, wealthy entrepreneurs, business people, etc., can go to the Shanghai Gold Exchange and they can buy gold, gold futures. Then they can take actual delivery. And even international investors in Hong Kong or in Shanghai or in Singapore and any of these regional cities can go to this exchange, buy it, and demand physical redemption. And the exchange will honor it because the exchange is set up to have physical gold storage facilities, transportation facilities, security. They have a literal wall between their own commodities exchange and the Shanghai International Gold Exchange. And what this has done is ever since 2022, there's been an arbitrage that has started to take place between the East and the West, where Eastern prices for gold and silver have risen markedly above the Western prices. And in one Substack piece I did back in 2020, this was like maybe April of 2024, I analyzed why is it the case that we're seeing this happen. And it's because this internal domestic investor demand is driving the price of gold between $50 and $70 higher on mainland China than it is in the West. And so what was happening is all these traders saw this arbitrage opportunity where they can buy COMEX futures in the West $50 to $70 cheaper. They can take delivery of several thousand ounces, and then they can ship those ounces over to Shanghai and sell them for a spread. And if at a small scale, this doesn't work. But if you're doing a big enough trades, like we're talking tens of thousands of ounces, it does make a lot of money. And it's just a free way to arbitrage these markets. And so what was happening is the COMEX was getting drained of gold and slightly of silver, but mostly of gold. And all that gold is flowing east. And so that was causing the gold market to ratchet upwards and to be adjusted upwards for the entire basically global market. And so that's why we saw a bull market in gold throughout all of 2024, even though the Fed wasn't easing and even though we didn't see a major macro indicator that should push gold from like 2000 to 2700. We saw that, which is like a 35% rally. We saw that happen, and that was mainly driven by Chinese buying. The difference this time is now it's coming from inside these countries. It's coming from the LBMA is getting buy orders from large institutions domestically that are asking for redemption, and same with the COMEX in Chicago. They're getting huge buy orders from domestic customers, and like real redemption requests where they want the physical gold. And you can see this even if you look at the Costco data. The Costco sells 1 ounce gold bars, and they also sell 1 ounce gold coins and silver, and they are getting sold out every single cycle. Like every time they do an offering, which is I think like once a month, they're getting sold out within a few days. And so the retail demand is extremely, extremely strong for the metals.
That is impressive. I didn't know that Costco was getting sold out every time that they were restocking. That is impressive. But the demand for physical gold goes up when you can only get certificates, and it takes 8 weeks to get a delivery on redemption that you have. That makes sense. What do you think happens to the U.S. Treasury market when we continue to have over 20 billion failures to deliver per day?
Well, the treasury market is different because you can print treasuries, you can't print gold. So the issue is, right, like if there is a massive naked shorting problem in the treasury market. Suzanne Trimbath pointed this out. Even in some books, like there's a book written by Scott Skirm called I think it's called Understanding the Repo Market or deep dive into the repo market or something like that. And in that book, he talks about the scale of the problem, and certain tenors and certain issuances of the treasury market are much worse than others. We're talking some have $1 trillion worth of fails on certain issuances of treasury notes. And it's usually like the 2, 5, and 7 year notes for some reason. I'm not sure why. But that problem is very systemic, and it's very common because you can, again, a lot of these brokers have unallocated positions where they can just naked short sell treasuries, say that they have the QSIP in their account. They don't actually have it. No one is taking delivery. And so they can just kind of get away with it, basically be creating synthetic, short treasury positions. The difference is that if this could blow up one or two small funds without causing much damage to the larger market. But if there's a widespread run on a treasury issuance, like let's say it's one of the 2 year floating rate notes, then that's a systemic issue that could affect the entire banking system. And that's when the Fed would step in. And if there's a shortage of that specific issuance, the treasury could just make more of it and substitute them. So, or the Fed could just buy all the outstanding ones and make everyone whole with cash. And so the difference between gold and treasuries is that they can actually print the treasuries. They can't print the gold. And so it's much more difficult to solve a gold run on the bank than it is to solve a treasury run on the bank, so to speak.
I enjoyed that answer. You can't print gold, but you can print treasuries, essentially.
Mhm.
Um, so you had also mentioned the reverse repurchase or the reverse repo market. We had saw that reach all the way up to like above $2 trillion in 2022, and now we're down to under 100 billion. Where do you think that capital is being allocated?
I think that money is flowing. It's flowing into basically the domestic dollar market, and that is subsequently flowing to equities and bonds. The reverse repo is interesting because, again, the reverse repo has been used in prior crises. Like if you look at 2008, it shot up to like 80 billion or so at certain periods of the '08 financial crisis, and it was even used for a little bit in 2013 during the Operation Twist that the Fed did. The problem was that this never was a major tool of central bank policymakers to reduce or to increase liquidity. But starting in 2020 and 2021, the Fed ran into the problem of they were shoving mass amounts of bank reserves into the system, and they themselves were becoming a suction, you could say, a vacuum for treasury bills. And the system actually needs treasury bills to survive. It uses debt as collateral to make a lot of these repo trades. And so if you don't have debt, then you have an issue. And so all this excess liquidity, they said, well, why don't we incentivize people to store this excess liquidity with us? So they raised the reverse repo award rate to 5%, and which is really good. Like that's as high as the interest on bank reserves was at the height of the hiking cycle. And so now banks or money market funds or any other institution can, or I should say any other institution, the approved institutions, authorized participants is what they're called. They can go and post their cash at the reverse repo. But that gives now the federal government a certain amount of cash they have on the system that they can drain when they need to by manipulating the rate. And that can help them put money back into the system without actually like doing bona fide QE, without actually going out and doing extra QE. All they do is change the amount of money in the reverse repo, because again, they can accept or refuse people's money. So they can tell people, no, we're not taking any of yours. We want you to keep it. We want you to shove this back into the system as liquidity. And by doing so, they can use these other institutions essentially as like their henchmen to push liquidity back into the system. And so the reverse repo spiked around 2.2 2.3 trillion at the height of the 2021 QE COVID bonanza, and it's been being drawn down for the last 2-3 years. And at the end of 2024, I commented on Twitter that if this thing runs to zero, that is likely the signaling of the end of QE of QT, right? They've been tapering the balance sheet, at least supposedly. Really, if you look at all things unbalanced, they stopped tapering in late 2022, early 2023. But if you look at like just the balance sheet, what they're doing nominally, they are reducing the balance sheet. And I said, this drain and reverse repo and the drain and the TGA are both offsetting the amount of money that they're tapering. But if we get to a point where we have no more reverse repo to draw down, then that means that they will likely have to be ending QT and at least be holding the balance sheet flat, if not starting to increase it again and start another wave of QE. So that's the most likely thing that it means in the near term. I'm not sure that I don't think it's going to mean a bank crisis is around the corner, because I think they've papered over that well enough by now.
In 2021, we saw the reverse repurchase agreements skyrocket. And then over the next few years, it has dwindled to nothing, or not nothing, but less than 100 billion was the last one I checked earlier this week. What happens if interest rates rise more, considering they've already risen over that time period that it's depleted? What happens if they have to raise them again because inflation is in fact not contained?
Well, it's going to be that's the difficult line to thread, right? Because if you're the Fed, you have this ostensible mandate, but it's not really a real mandate. The real mandate you have is financial stability. And the problem with holding interest rates this high is that with our level of debt to GDP and our demographic situation, you're starting to see the interest expense blow out. And that creates what I've called the Peruvian bull debt paradox, where the higher they hike, the further they move behind the curve. So it's kind of like a oxymoron, right? Like the more they hike, the more the interest expense rises on the national debt, the faster the debt grows, which means in the next cycle, the lower they're going to have to cut and the more QE they're going to have to do, because the treasury is going to start spitting out all these treasury bills. They're going to be, it's going to turn from a trickle to a stream to a deluge. And that process of exponentially increasing treasury issuance is not good for anybody, because there's just no room to store it in the financial system. There's not enough liquidity. They've already stuffed the banks with it, with Sarbanes, well, not Sarbanes-Oxley, but with Basel III, and they've already stuffed the money market funds with it with the money market reform in 2014, and they've already thought about stuffing the banks with unlimited leverage with the permanent ESLR exemptions. The letter that they wrote last March to that ISDA wrote to the Fed and the CFTC and the OCC. So there's already a large scale push from people in power, from the monetary authorities, to find out how to deal with this massive treasury issuance. And if they hike rates into a inflationary recession, you could say, that will make the deficits blow out, because the interest expense will blow out as well. But the problem is, again, if they lower rates into that, then they're just going to increase inflation and the deficit is going to blow out anyways. And so they're kind of stuck in this catch-22 where they're damned if they do, they're damned if they don't. If they hike rates, it makes it worse. If they lower rates, it makes it worse in a different way. So there's really not much they can do. But the difference is that one way will break the financial system, the other way will break the real economy. And whenever the Fed has had a choice between the financial system and the real economy, they've chosen the financial system every single time.
So, to simplify that, you believe that they will save the banks over
Yeah,
curbing inflation.
I believe that they'll cut rates. Yeah, if they have a choice between the two, they're going to cut rates.
What is your take on the current state of BRICS versus SWIFT? Do you believe more countries are continuing to leave the dollar for other, options such as BRICS, or is SWIFT sort of remaining the dominant in the market?
Well, the problem with BRICS is that they're kind of like a disorganized, band of unlikely, you know, bedfellows, let's say. You get them if you're like familiar with like, those high school comic book movies where, they have like the cool kids, like the 80s movies, Ferris Bueller's Day Off, those kinds of films. Um, you have like the cool kids, you have the jocks, you have the nerds, you have the drama kids, you have the the kids who kind of grift in between, the emos. Like there's this kind of assortment of people. And Swift is like basically you could determine as like the popular kids, the kids in power, the kids who have authority in the school, who have all the positions of control. And then the bricks is like a weird consortium of all the other kids, all the other smaller subgroups that are trying to fight against the popular kids. And the issue with that is that you know, Russia, China, India, South Africa, Brazil, like all these countries, and even and last year I wrote a huge section of a report for In Gold We Trust, which is a one of the most widely published gold research reports in the industry. And I wrote like a 30 to 40 page research piece for them on de-dollarization. And I was analyzing BRICS for a large part of this. And the issue that I found was that, look, even though they had 20 or so countries at least apply to join BRICS, and they approved some of them, um, they're all just making, I guess you could say, like superficial, convenient statements and not actually doing anything about it. Because the problem is the gap between actually implementing what they want and saying what they want is huge. If you're BRICS, right? Let's say you're Russia and you're promoting a common commodity currency based on gold between you and India and China and South Africa and Brazil. Well, where do you store the gold? And who audits it? And who backs it? Maybe you trust yourself, you don't trust China, you don't trust India to store it for you. And if you let them do that, then they could have control over the so quote unquote like commodity currency. And if you let China take control of it, well, they have a closed capital account. They don't allow money to flow in and out of the system freely. They'll allow imports of gold and silver. They don't like to allow exports. And India could have issues with naked shorting, with delivering, with actually keeping honest on their promises. I mean, their own currency is at an 84-year low or whatever against the dollar. It's collapsing. So there's not any single entity that you can trust. And any commodity currency is going to face the same issues as Triffin's dilemma, where it needs more and more needs will need to get exported. That means you have to accumulate more and more gold and silver, and there'll be a point at which the purchasing power of the country is just not strong enough to get enough gold and silver to back it. So BRICS, in my opinion, and I've written about this before on the Substack, it's kind of like a nice dream, like a nice uh, uh, yeah, a nice dream that people could have one day to compete against Swift. But really, the only thing that's going to defeat Swift is something that's not a fiat currency at all, something like Bitcoin, because the problem is
I
it's just too entrenched.
My next question was literally right down that line as what would be a solution to where country like in the ragtag group of BRICS, what would be required in your opinion to facilitate trust in a trustless society?
Well, that's where Bitcoin comes in, right? They say, trust but verify, but you don't need to trust anybody with Bitcoin. It's all backed by math and encryption and game theory, right? So I know that I hold Bitcoin. And if I know that you have an address and I can check your address and see what kind of influence you've been having, and if I approve of you as a person, I can send you Bitcoin and we can make an exchange of value for goods or services. And then you can export the goods or services to me. And Bitcoin currently has the transaction capacity of FedWire, which is the Fed's own global banking payment system that it uses for the entire US dollar network. And so it's already on par for large payments. and it could be used as a reserve currency in that manner. Now, the problem with Bitcoin is that it obviously doesn't have the transaction throughput to be used on the base layer as a currency for everybody, because Visa handles like 60,000 transactions a second, and this thing can do 7. So we're talking multiple orders of magnitude too little. But second layer solutions and third layer solutions, second layer like Lightning and third layer like Liquid, could provide solutions for people that would allow it to scale to global adoption without having everyone clog up the base layer. And so I think, really the only thing that would defeat Swift would be something like Bitcoin getting adopted on the nation state level, on the corporate level, being used in international transactions, settling debts, settling contracts, and being used for international trade. And that the flywheel effect, especially if the US is the first mover, that will put the target on every single central bank's back to start buying some and start using it for international trade.
Okay. And while we're on this topic, one of my big words that I said would be 2025's hot word is tokenization. How do you see commodities and stocks, both stock exchanges, whether it's New York Stock Exchange or London or Hong Kong? How do you see the process of tokenization occurring throughout the entire industry, really?
The process of tokenization of like stocks.
Yeah. How do you see adoption occurring for, tokenization of our current RWAs, the real world assets? They are currently being pushed pretty heavily. I know the DTCC is working on Project Ion with Euroclear to where they are specifically tokenizing stocks. You have other companies like T Zero, who is a who has an approved broker dealer for the tokenization of securities through Biddle, and then there's a few that are currently working on tokenization. Do you think that that process is going to help solve the issues of our trust-based debt economy of guarantees?
Yeah, I think so. With the blockchain solution, right? To especially like let's bring up naked shorting and failure to deliver and those issues. The blockchain system a public ledger could solve that issue pretty easily, right? The problem you'd have to have it or solve for is transaction throughput, because something like the stock market, there's I don't even know how many trades, hundreds of millions of trade, billions, trillions of trades that happen every single day. And so you would have to first put a limit on high frequency traders because they can't be clogging up the blockchain with 10,000 transactions a second. You would also have to think about how you structure derivatives in that environment and how derivatives are settled, and to what extent you allow derivatives to be transacted in a fiat system. And you would also, right, probably have to have trade-offs in terms of decentralization and security. There's a famous article by um, Buterin, Vitalik Buterin. That's his name. I almost said Vivek. But there's a famous article by Vitalik that he lays out what he calls the blockchain trilemma. And he basically creates a triangle, and he says, okay, you have decentralization, security, and transaction output. And you can optimize for 2 of the 3. You can't have all 3 because they're mutually exclusive. The more you go for decentralization and the more you go for security, the lower your transaction output is or throughput is. And that's what Bitcoin did. Bitcoin maximized for security and decentralization. And then if you maximize for, like, let's say security and transaction output, then you don't have good decentralization because you can't get the information to and from the nodes fast enough. And same thing with the other way around. If you really get decentralized, that's possible, And if you really get high transaction throughput, that's possible, but then you have low security. You'll have to have, limited hashing algorithms, not as sturdy encryption. You'll have to make things simpler and easier for the nodes to digest and relay information. That will result in lower overall network security. And so you basically can have two of the three. And if you're a stock exchange, well, you kind of probably have to optimize for security and throughput and give up decentralization. And so again, you could create a blockchain where all this stuff is where you're able to trade stocks and tokenize stocks, for example, but you'll probably have to have it be pretty fairly centralized. And so that means that it's not going to be the same as a Bitcoin based monetary system. It's going to be much more like there's 10 entities that run mining mining rigs or whatever, and that they're the only 10 that are approved to mine the blockchain and to create the next block. The benefit though is that if you make it a public block, then everyone can see it. And yes, even though we know it's captured to a certain extent, it's obviously much better than our current system. It's less captured. And so that's probably the way that they do it.
Okay. And do you see tokenization coming to the New York Stock Exchange?
Hmm. Yeah, well, so the NYSE bought that one company T0, right? And it looks like they have been making moves on the back end to try to update the stock exchange to accept basically blockchain settlement. I think we'd still need to see an MVP proven out. We'd still need to see certain stocks, like let's say them try it on Apple or Amazon or Google, and then they'd have to roll it out to the whole market, because fucking up something like this, you're not fucking with just someone's healthcare records or something. This is trillions and trillions and trillions of dollars worth of wealth of Americans, foreigners, institutions, and if you're messing with people's wealth, that's a very serious problem to attack. So it's almost like they have to have all their T's crossed and their I's dotted before they make sure that they do anything with the stock market, especially something like changing it into a blockchain settled system. So I do think that they're working on it because of their acquisition of T0 and because of their partnership and some of the evidence I've seen of the NYSE, for example, working behind the scenes. But I'm not sure how far along it is, and I'm not sure, if they're even really going to do it. So
To make it a little more complicated, um, derivatives are all traded, or well, most derivatives are created to be monetary value equivalent in US dollars. So most things actually settle in cash, or well, like cash monetary value equivalent. How do you think, or not so much how, but if a blockchain based exchange were to take, you know, full full swing and people started adopting and using it, what do you think they would choose for the monetary value equivalents that they end up, basing what the derivatives values are on? As in, is it going to be a stable coin? Is it going to be like, are they going to create their own sort of token to represent a certain monetary value? Or what do you see them using as that solution, considering they do put almost all derivatives in a monetary form, which is exactly why if you buy a stock, a US based stock in Europe, you are buying the monetary value amount of that security that is then held through, Euro clearing them.
they don't have. I mean, if you have a blockchain based system, right? It is probably easiest to use stable coins or some other form of like a stable rail to transact rapidly, right? You can still do it with fiat. You can still just have fiat transactions and have them all in an internal SQL ledger and then just settle them out, balance the books at the end of the day. So it's not impossible to do it with fiat. But yeah, they could use a stable coin. There's almost no world in which I see them creating their own token for this purpose, just because it doesn't make sense for an institution that large to try to compete with the US government and the dollar. Like
Well,
why would they make their
and
own
it
token?
was, yeah, and it was stated there won't be a CBDC, or at least under the Trump administration. But do you see a different sort of solution perhaps coming out if we were to continue this move towards a blockchain based exchange with tokenized securities?
What they'd probably do is just expand the normal use of stablecoins that they've already done. So they'd probably just tell USDT and Circle and say, "Hey, we want to have more stablecoins. We're going to bring on giant amounts of capital. We need you guys to be our partners. Can you just basically prep your systems to be ready for um, this amount of volume?" And then they'd have to work with them to approve it. But I'm sure they would say yes.
Okay, yeah.
Mhm.
That's it. Right now, that thing that I brought up earlier, the DTCC's Project Ion, that is to create a parallel exchange to mimic the current to test the bounds, and I believe they are partnered with Circle in that.
Hmm.
But that
Okay.
also goes. They also are partnered with people like Toyota, where they're trying to create, their digital ID for the vehicle and for each person. So, it has its own risks associated with that.
Hmm. Okay. Yeah, no, there's definitely like people pointed out that is the proliferation of the stablecoins is problematic for a couple reasons. For one, USDT Tether has famously not had an audit since like 2020, and there's been speculation for years that Tether is basically committing fraud. It doesn't have the treasuries that they say they do, or that they're invested in Chinese commercial paper. There's a rumor and someone had some like insider financial statements back in 2021, 2022 timeframe with the blow up of Celsius showing that Tether had like 70 billion or something of Chinese commercial paper that was basically worthless. And so that's been on the rumor mill for a while, but it's nothing's ever come of it. They haven't been audited and they haven't gone bankrupt so far. So they have the liquidity at least to manage what they have. Now, if they're going to scale to this size, they need to be audited and they need to be, basically pulled under the thumb of the US government. Something that most people don't know is Tether's actually not domiciled in the US. Their main operations are in the Cayman Islands, um, and Puerto Rico. And so, like, and Puerto Rico's weird because they're a territory, not a state, so they have different laws. So they're able to get around a lot more of the U.S. normal sanctions. And
Well, and
so,
in Puerto Rico, isn't the dollar, or isn't their money pegged to the US dollar?
no, they use the U.S. dollar.
Oh, okay, so they
They
do just
use
use.
they do use the U.S. dollar, but Puerto Rico is kind of like a hotbed for people trying to avoid taxes because, for one, it already, because they're not a state, they get rid of a lot of the taxes. But as far as I know, Tether is headquartered in the Caymans, which is even more obviously sketchy. So they would need to be brought under. But the thing is, Tether and Circle are now huge buyers of U.S. Treasuries, which the U.S. government desperately needs. Like we said, they're in a massive debt spiral. The amount of debt that the Treasury is issuing is growing by like a 40% CAGR in the last 2 years. So it's unsustainable, and they need to find new buyers if they don't want to just do QE infinity. And one new buyer that would be easy to find is stablecoin issuers, right? You push everybody into stablecoins. You don't even need a CBDC. You just have everyone go into stablecoins, and you have all their money flow into USDC, and then all that money is backed by Treasury bills. Now the Treasury has a huge new buyer of their debt, and that's continually there and has continuous demand. And so, if this can grow to be big enough, it can easily become a major player.
How is Tether functioning, considering that their only proof of reserves that was given ended up showing that they had like 70% in commercial paper in Evergrande, and Evergrande is defaulted. You mentioned Tether, you mentioned Evergrande. I was just trying to bring it
Ah,
together.
I see.
It's not a, it's a speculative question anyways. It's
I well, that's the thing is I know that they had Chinese commercial paper. I didn't know it was Evergrande's paper. I mean,
that was why everybody was like, what in the hell? And Tether's gonna collapse. But they didn't.
well, yeah, they didn't collapse, and again, that should tell you something that that they're sturdier than at least than people think. And to be fair, again, if they want access to our capital markets, they really should be audited and regulated by a government entity. And there shouldn't be any runarounds or workarounds that they can do. If they do have Chinese commercial paper, that's extremely dangerous because not only are these companies very rickety from the financial perspective, the problem is that China is not the same open free capital market as the US. The Chinese have stipulations in their legal code that designate foreign investors differently than domestic Chinese investors. And so what that means is that, for example, Country Garden, when they defaulted on their dollar bonds in August of 2023, guess what? They didn't pay sovereign foreign creditors. They had foreigners at the bottom of the cap table list, at the bottom of the liquidation preference in terms of payouts. And so the people to be wiped out first are those foreign bondholders. And so if Tether really does have Chinese commercial paper, it's probably worth zero. And it's probably if it's Evergrande specifically, it's probably worth zero, and they're probably never going to get their money back. And of all creditors, they're the least likely to get any money back.
Yeah, and that's been my biggest concern about Tether is that the only insight that somebody sneakily got, and it was proven in court that that document was real because they claimed it, and that's why they were able to cross sue for that person to remove it from the internet. Well, thank you to that person for posting it to the internet because
Mhm.
the internet never forgets. So that's the only reason why we had that in the first place was because they sued the guy that posted it for posting their legal documents.
Mhm. Exactly. So, yeah, it's dangerous. If you're a whistleblower, I mean, dude, look what happened to the OpenAI guy. Gets whacked. Boeing whistleblowers, they get whacked like every single time. And so, if you work for one of these institutions, in my opinion, you have to release this data anonymously, and you have to do it in a way that it can't be traced back to you. So which is difficult to do, but you got to be careful for sure.
Definitely stay safe in this crazy world. Um, so I guess we can pretty much wrap it up. This has been a fantastic conversation. If people want to find you, where can they do so? If you want to plug real quick.
Sure. So you can find me on Twitter, obviously, at Peruvian_bull. I also have a Substack called $endgame.substack.com. You can check that out. I also have a YouTube channel, Peruvian_bull, and all my content is there. I'm going to be producing more YouTube videos and hopefully more documentaries this year. So we're going to be diving into, the central bank of Japan. We're going to dive into, hopefully, I want to do a documentary on the Fed and the evils that it's created. Last December, I released a documentary with Ian Carroll and Julian, and we did one on Jekyll Island and the origins of the Fed. So I want to continue that series, and I think it'd be really cool to do that. But yeah, you can find me there. I'm always active on Twitter, so just look me up.
All right. Well, thank you and enjoy the rest of your day.
Awesome. Thank you so much.
Thanks for joining me tonight. I enjoyed having a conversation with Peruvian Bull on topics that ranged from crypto regulations to Swift versus BRICS into a discussion about the crypto golden bull market. We even touched on the debt paradox and what crypto will need moving forward to have a future in the US. So, if you enjoyed this episode, please be sure to follow, like, share, and subscribe. Doses and mimosas.
Printing money out of thin air, banks create a dream. Loans based on credit and infinite liquidity, nothing's as it seems. Assets backed in the vaults, no, that's just a guarantee. Fractional reserve lending is quite risky. Join the tally stick and see.